Bloomberg Audio Studios.
Podcasts, radio, news.
This is Masters in Business with Barry Ritholtz on Bloomberg Radio.
This week on the podcast, I have another extra special guest. Dr. Ed Yardeni is really a legend on Wall Street. He is both an investment strategist and an economist, and I'm very comfortable saying he does that better than anybody else. He has had a number of major market calls and economic calls that have been notable not just because they were right, but for the way he uses data to reach the right conclusion. He has consistently been bullish since the market bottomed in March 2009. He has talked about where a recession is and isn't coming. He's more or less nailed what the Fed was going to do, even though a lot of these calls have been outliers and very contrarian compared to the rest of the world of finance. Ed is a neighbor of mine, lives the next town over. I've known him for a long time, and I've just marveled at how he thinks about markets and the economy and government and data. I subscribe to his daily notes and find them to be tremendously useful in contextualizing the fire hose of data, looking at what's important and what's not, and how much of this stuff is just noise. I found this conversation to be informational, educational, and fascinating, and I think you will also. With no further ado, my interview with Dr. Ed Yardeni. Dr. Ed Yardeni, welcome back to Bloomberg.
Barry, it's always a pleasure. Thank you for having me.
Well, thank you for coming. It's always good to see you. We're neighbors. We probably don't get to see each other as much as we did pre-pandemic.
We have to catch up.
We still have some bad pandemic habits that we have to break. Let's talk a little bit about your background. You have a fascinating academic background, a PhD in economics from Yale, and your thesis advisor is Nobel laureate James Tobin. Tell us about working with Tobin.
Well, it was certainly an honor and to work with somebody who won the Nobel Prize for his contribution to economics. But sometimes it wasn't that easy to understand his theories because they were mathematical and got complicated. But as a result of that, I turned to Janet Yellen. Janet Yellen had graduated from Yale in their PhD program 6 years before I attended. And she took meticulous notes. She must have been one of those, very focused students sitting in the front row of Tobin's class 6 years before I got there. And she took meticulous notes, just great notes, and they were Xeroxed. And I think most of us who studied under Tobin basically got through Yale, got our PhDs because of Janet Yellen's notes.
That's really interesting. The undergrad at Cornell and then a master's degree also at Yale. Well, that seems like a lot of education. Was the plan to go into academia, or was it always Wall Street?
Well, I didn't really know what I wanted to do when I was an undergraduate, so I took everything from a couple of courses in engineering, physics, math, political science, and economics. And based on all that, I realized I wasn't any good at math or at physics, so I had to go into something a little softer and easier. So I did go into a combination of politics and economics. And then for my master's, I went to the International Relations program at Yale, which combined economics and political science. And then as I ended that 2-year program, I realized I'd accumulated enough to basically do a PhD in 4 years there as well, on top of, not an extra 4 years.
One more year to go.
Yeah, and then I just had to write a PhD dissertation, and I'd seen too many of my fellow students who are kind of hanging around the graduate program because they couldn't quite finish their PhD dissertations. I decided I was going to get out of there quick, and so I wrote a dissertation, an empirical one, that confirmed a lot of Tobin's theories. He absolutely loved it, and let me move on from there.
So you graduate with a PhD in economics in 1976. We're going to talk about inflation later, but I have to ask, a lot of your peers who graduated in the mid-'70s, it seemed to really leave a mark on them. Unlike most of them, you nailed inflation on the way up, you nailed it on the way down. so many of them seem to be scarred by their 1970
Right.
experience. Why did that whole era of economists, and I'm including like big names like Lawrence Summers,
Right.
why did they get this so wrong?
I think that they first start out with theories and then look for data to support it. And I can't really generalize about the economics profession, but I think there isn't enough attention to just, dealing with the facts, with the data, and with historical events. I lived through a lot of those historical events and learned from them. But I observed that, inflation was in fact brought down in a very conventional way in the late 70s, early 80s with very tight monetary policy. And then in the 80s, I observed that we were seeing deindustrialization in America, but that was because of globalization.
Right,
And
which
so-
was deflationary.
Which is deflationary. And in fact, I think it was in the early 80s, I don't know, I think it was 82, 83, I predicted that we're probably going to see a period of disinflation. And part of that was also based on my view that as globalization prevailed, there'd be more global competition, and that would keep a lid on inflation.
And you also wrote a piece in 2023 about why conventional forecasting models were so wrong. And a lot of
Right.
people, in particular, you
Yep.
mentioned Jamie Dimon, had been expecting a recession.
Right.
It seemed like almost every economist was expecting
Yeah.
a recession, and it never showed. What did you get right? What did they get wrong?
Well, I think most economists very logically believe that if the Fed's going to go from zero on the Fed funds rate to 5.25%, how could we not have a recession? My argument was that while the Fed certainly was tightening, they were also normalizing. I mean,
Right.
so you had to not only look at where interest rates had gotten to, but where they came from, and they came from zero. So the real abnormality was the ultra-easy monetary policy that we had from the great financial crisis to the great virus crisis. And I felt that the economy was demonstrating that it could handle it, that it would be, in fact, relatively resilient. And of course, you have to get the consumer right. And along the way, I concluded that while Jamie Dimon and others were focusing on the consumer running out of so-called excess saving, the idea that was that consumers had accumulated $2 to $3 trillion during the 2 months of shutdowns, and then for all the helicopter money that was deposited in their accounts, I was pointing out increasingly that, well, wait a second, the baby boomers have $75 trillion in retirement assets, and you know what? They're starting to retire. And
I love that chart. You actually showed that chart today.
Yeah.
Net wealth it comes from the
the
flow of funds report from the Federal
Correct.
Reserve. But when you look at the millennials and the Gen Xers, wasn't everybody predicting the boomers were going to go broke? They wouldn't have any money retired. 75, almost $77 trillion. That's a lot of money.
That's a lot of money. It's an all-time record high. The household sector in its entirety has over $150 trillion in net worth. And that's assets minus liabilities, and it's all sorts of different assets. It's houses, it's stocks, it's pensions, it's the whole thing. So that's at a record high. And the baby boomers own half of that, roughly $75 trillion. And then the younger generations are kind of looking at mom and dad starting to retire, said, I wish you a long and happy retirement, but don't spend it all. And so I think the savings rate's going to remain extremely low because the baby boomers are not saving anymore. They're spending. And I think that the younger generation can actually look forward to some substantial, as being substantial beneficiaries of inherited wealth.
Let's roll back to the work that you did with James Tobin, and I believe he won the Nobel Prize for his work on fiscal spending.
Yeah. Mm-hmm.
So when you have the CARES Act 1, which was 10% of GDP, and then
huge.
the CARES Act 2, and then the CARES Act 3, shouldn't that offset whatever the Fed's going to do? And by the way, 5% isn't outrageously high. That's kind of average.
Well, I think that's another good point, is that not only did the consumers turn out to be resilient, and they remain resilient, they're still spending, and labor market's been really tight. The reason for that, of course, is the baby boomers are spending more on going out to restaurants, traveling, healthcare services. So guess what employment is doing in all those industries, all-time record high. You don't get a recession when construction and total payroll employment are at all-time record highs. That's the other reason why the economy has done well, is there's been a tremendous amount of fiscal spending that has led to record spending on infrastructure. I mean, you can actually see it in the data. It's not just there was an act and then nothing happened. There was a lot of spending. And then, of course, onshoring received a lot of tax benefits. So we've seen construction of factory facilities just exploding to the upside. And again, those are all construction jobs, and they're going to need employees and so on.
So nice tailwind. We'll come back to that a little later. Let's stay with the early days of your career, because I really find it kind of unique. You're an economist at the New York Fed in 76 and 77.
Right.
You're fairly young and new then. What were you working on when you were at the New York Fed?
Well, just by happenstance, they put me on writing memos, updating data. It wasn't real exciting stuff, but I focused on the savings and loan industry. I mean, you can't think of anything like more boring and useless than analyzing the savings and loan industry in the late 70s.
Right before it blew up.
And then it blew up, and then I'm suddenly on Wall Street, and I have a lot of knowledge of just what was going on in the S&L industry. So it really helped me to understand that crisis.
So here's what I find so fascinating and unique about your career. You have been chief investment strategist at places like Deutsche Bank and Prudential, but you were also chief economist at E.F. Hutton, Prudential Base, C.J. Lawrence, which eventually gets bought by Deutsche Bank.
Right.
Like, that's a rare pair of hats for one person to wear.
Right.
Tell us a little bit about how you managed to do both jobs.
I did start out as an economist. I think I was at E.F. Hutton for about a year or two, and then the chief economist decided to move on. And so only a couple of years into a Wall Street career, I was chief economist of E.F. Hutton. So that was pretty exciting. But I learned a lot from the strategist I worked with. There was a fellow by the name of Greg Smith, who was a strategist at E.F. Hutton. Jim Maltz was a well-regarded strategist at C.J. Lawrence. And so I learned a lot from them, and an opening became available to be a strategist at C.J. Lawrence, which by then had become part of Deutsche Bank Securities. And I jumped at it, and I said, look, I think I can do both jobs. And it just, to me, made sense to do both jobs, because I don't know how you can be, a well-informed strategist without understanding the economy.
So when you were working for Lawrence as part of, and eventually become chief investment strategist at Deutsche Bank, what was that like, given the fact that they're based in Germany? Many, I don't want to say most, but many of their clients are European. How did that change how you looked at the world?
Well, I didn't really work for Deutsche Bank per se. I worked as the chief economist and strategist for Deutsche Bank Securities, which was still, to a large extent, based in the United States and had international clients, but we certainly had plenty in the U.S. So the transition from C.J. Lawrence being independent to C.J. Lawrence evolving into Deutsche Bank Securities, nothing really changed for me, quite honestly. What was very visible is Deutsche Bank spent a tremendous amount of money on expanding, and so they hired the Frank Quattrone Group.
Oh, sure.
Yeah, and in the research investment banking department for a couple of years. At the time, Quattrone brought Amazon to the marketplace, and I'm kicking myself. There it was, I think $13 before all the splits. But it was an exciting time.
Sure. Let me ask you about that exciting time. You're on Wall Street in the 80s and 90s, arguably the biggest bull market of our lifetime. We'll see how far this one goes, where we are today. What was it like in that era when people were still stock pickers, active mutual funds were attracting the flows? Everybody thought they could beat the market. We didn't quite have all the data yet. Tell us what that era was like as a chief strategist on the street.
Well, the 80s were certainly interesting, and near the tail end we had the crash in the stock market, the one-day crash. I scrambled to kind of understand what was going on, concluded it was portfolio insurance, and that the week before, the House Ways and Means Committee was starting to talk about taxing some of these transactions that were going on in M&A. And so a lot of the M&A stocks got hit quite hard. And my conclusion that it was largely a reaction to possible government regulation, and that it probably would pass. And Rostenkowski, who was the head of the House committee at the time, did in fact pass on it in December. Suddenly it just kind of evaporated. So I concluded within a couple of days that we were probably making a low in this bear market that only lasted really a few days. I mean, officially it was October to December. But
well, to be fair, I want to say by August of '87, S&P was up 40-something%, and we finished the year plus 1%.
Yeah.
So that's quite a whackage. That would constitute a bear in my book.
Right. In the early 90s, I started to recognize the technology revolution that was going on, and I got
You were early and vocal.
Well, I was early and vocal, and as a matter of fact, I walked into a Barnes & Noble store, I think in 1994, early 1995, and I'm pretty sure that I was the first one to have a website on the internet, obviously, on Wall Street. I know no other economist had it. I don't know how I got away with it at Deutsche Bank, why they would allow, Dr. Ed Yardeni's Economics Network to be featured on the internet without any real mention of who I worked for.
Well, maybe that's the German ownership didn't understand U.S. compliance rules.
I suppose so. At that time,
who knows?
Who knows?
You launched in January '07, not that much earlier than the financial crisis. Tell us what led you to launching Yardeni Research.
Well, I had been on Wall Street for many years. It was getting a little stale. The lawyers were starting to take over, and there were more limits on what you could write about or who you could talk to. Even in your own shop, you had to get approval to go down to the trading desk. It just wasn't as exciting as it had been in the early 2000s. And suddenly, out of the blue, I got a call from Jim Olschlager, who runs Oak Associates in Akron, Ohio. And Jim was looking for somebody to work with him as a strategist in Akron, Ohio. So I talked to him, and it sounded like a great opportunity. He made me an offer I couldn't refuse. So I accepted it, and it was a 3-year deal. And it worked out fine, but after 2 years, I kind of missed just doing what I'd been doing on the street. Meanwhile, Jim had allowed me to continue to write and to keep in touch with my client base. So I left in the end of 2006 and January 1st, 2007. I started the Yardeni Research as an independent research provider.
Did you move to Ohio, or did you stay put?
Actually commuted. They have a great airport there. Canton Akron Airport's a wonderful airport.
Farmingdale or LaGuardia to Akron?
LaGuardia. And I'd leave on a Sunday and sometimes hang around there until Wednesday or Thursday. But so I just kind of commuted, and that was okay with Jim, and it worked out fine. And of course, I did some marketing with him, so I would kind of meet him at different parts of the country, and we'd market together.
Let's talk about your clients. I'm assuming they're primarily institutional?
Well, they have been primarily institutional, since I've been on Wall Street. I guess, I did work for some firms that also had a huge retail base with like Prudential, so I certainly had a lot of interaction with both institutional and retail. When I moved to C.J. Lawrence, is primarily institutional. It was all institutional, really. And then when I went off on my own, I continued on with an institutional bent. The research was aimed at a fairly sophisticated professional investment community. But about 2 years ago, we realized that there's a demand for what we do among individual investors. So we came up with something called YardeniQuickTakes.com, and that's a daily, and it's shorter and it's to the point, and it does what I've always done, which is kind of combine strategy and economics.
I was going to say, you also put a lot of information online that's there for free.
Right.
I don't mean like a chart here or there. Huge runs of data and charts, and it's updated like daily.
Yeah, it's automatically updated.
How do you manage to handle all this? That seems like a lot of work that you're essentially giving away.
Well, several years ago, I didn't see the point of doing all these charts manually over and over again. And, would you run this chart? Where is it? And so we came up with an in-house program. This was when I was still on Wall Street, an in-house program that ran these charts automatically when the data was available from our data vendor. and updated the charts and then put the charts in the proper place in PDFs that focused on those particular topics. It worked great. I mean, I think it was in some ways a very crude artificial intelligence tool. I should mention AI at least once in our interview here, right?
Oh, we have lots of AI to talk about a little later.
Yeah, but so anyways, this smart program figured out how to ping the vendor and say anything new for me. And if there was, everything would be updated automatically. And we're still doing that. And look.
And that's at Yardeni.com.
Yardeni.com, yeah. Now, if nobody was looking at our charts, I would still have the whole thing because that's what I use to write. And so what I'm doing is basically sharing the puzzle pieces. And anybody who wants to see how I put the puzzles together has to subscribe to our research.
And just to put some flesh on those bones, you post on valuation, the global economy, the U.S. economy, inflation, credit, consumer spending, employee markets, pretty much anything that there's a regular data stream, it updates automatically.
That's correct.
It's really, really intriguing. Yeah. Let's talk about putting some of those puzzle pieces together. You talk about the mega cap 8, the Magnificent 7 plus Netflix.
I like movies, Barry, so
I'm well aware.
I didn't want to leave Netflix out of there.
Let me steer you away from the new Wonka movie because it's terrible. Okay. But how important are these 8 stocks to the overall market this year and last?
Well, I mean, arithmetically, they're very important. They're about 28% of the market cap of the S&P 500. So they're huge in terms of their impact. And some people look at that and say, well, that's not healthy. It's a sign that this market is vulnerable. And I'm empirical about it. It is what it is. These are great companies. They're here to stay. They've had a couple of sell-offs that turn out to be great opportunities to get into those stocks. So I think we have to factor in that when you look at the valuation multiple of the S&P 500, maybe it's not the historical average of 15 anymore. Maybe it's something more like something north of that, maybe even closer to 20, which is where we are right now. And nobody seems to be particularly bothered by it because these are companies that, in fact, have earnings, have customers, have a tremendous amount of cash flow, and don't seem to be that interest rate sensitive. They've got all the money in the world to expand, and they're always looking for new businesses.
Michael Mauboussin put out a piece a couple of years ago talking about the intangibles, that this market is not like the market of 100 years ago where you had giant factories, big foundries, massive demands for labor, material, and income. A lot of the wealth today, a lot of the assets of these companies today are intangibles. They're copyrights, they're trademarks, they're algorithms.
Intellectual wealth,
IP, all this intellectual property. Are we rationalizing a pricier market, or is that a fair explanation?
I think it's a fair explanation. I think it's also important to realize that the bull market we've had and the upward trend in the stock market certainly reflects the fact that the country is getting wealthier and wealthier. I know this is a very controversial subject because once you start getting into income and wealth, people talk about it, income and wealth inequality. But I think a fair amount of that is related to demography. And as we said before, the record household net worth, record net worth for the baby boomers. And so there's a lot of money out there that needs to be invested. We're seeing that even in the government bond market. I mean, we all know that a lot of people have been pouring money into NVIDIA and into some of the other mega cap 8, though it seems to be the rally within those 8 is even starting to narrow a bit of late.
Someone called it the Fabulous Four.
Yeah, but that will be meaningful until it isn't. I mean, I don't know that you want to bet against Elon Musk and what he's doing with Tesla, but that's been an underperformer.
Yeah, that's got cut in half over the past couple of years.
Yeah.
So, people talk about the mega cap 8 as proof that the market is narrowing, and that's negative.
Yeah.
But a quote of yours, quote, the new bull market has actually been fairly broad all along.
Yeah.
Discuss.
Well, again, we start with the data and then come to the conclusion rather than the other way around. And so a lot of people have been looking at various measures of market breadth, like the ratio of S&P 500 equal weighted to S&P 500 market cap weighted, and it's been going down. So clearly the market's getting narrower. But when you actually look at the 100 plus industries that are in the S&P 500, what you see is that the sectors that have the mega cap 8 in them have done extremely well because of the outperformance of the mega cap 8 stocks. But then you also see that, well, wait a second, there's a lot of stocks that are up and industries that are up a measly 20%, which is kind of bull market territory. So I think it's kind of a relative game. I mean, some stocks, particularly the mega cap 8, have done remarkably well, and there have been lots of others that have done unremarkably well, but very decent returns.
So another quote of yours I found kind of fascinating. People keep talking about NVIDIA like it's a bubble, but the NVIDIA stock price is up about the same amount as NVIDIA earnings.
Right.
How can that be a bubble?
I don't think it is a bubble. It just looks like a bubble on a chart. Anything that,
Goes vertical like that?
Yeah, when everything goes vertical like that. Look, at some point, NVIDIA, because it's getting so much press, so much buzz, and is making so much money with such high profit margins, is going to attract a lot of capital into competitors, and it's already doing that. NVIDIA could be put out of business like overnight if somebody suddenly came up with a quantum computer that worked and operates lightning speed compared to half lightning speed of NVIDIA's chips. But NVIDIA keeps innovating, and that's what's so exciting about technology. Technology is always moving forward. It's actually a source of deflation because technology prices decline, and in addition to that, technology boosts productivity.
So we've seen this sort of single stock going vertical before. We've seen it with Intel. We've seen it with Cisco.
Yeah.
There's always one company that, is in the right space,
at the right
captures
time.
lightning in a bottle, and, all bets are off. But it sounds like we're not that late stage for NVIDIA here.
Well, a lot of... In the past couple of years, we've all been comparing the current decade, the 2020s, to previous decades. I've seen similarities between the 2020s and the 1920s. Productivity, technology, excitement. It started out
that newfangled car had come out.
Yeah, it started out really depressing, and somehow or other, it just turned out to be the roaring 2020s. So there's that analogy. Then, as we discussed earlier, there's the 1970s, and that there's some analogies there. I mean, look, if the Middle East insanities eventually or at some point actually cause the price of oil to spike up to 100 and higher, it is going to be the 1970s all over again. But so far it hasn't been. I don't think it's going to be. But then there's the 1990s, and people have asked me, if this is the 1990s, where are we in the 1990s? I said, well, probably more like December 5th, 1996. That's when
Irrational Exuberance,
the Irrational Exuberance speech by Alan Greenspan, and he did a Hamlet on us. He says, "How do we know if we've got irrational exuberance in the market?" And the market actually sold off on it, figuring, "Oh my God, he's thinking irrational exuberance." He just asked the question, and then the way he answered is that maybe we don't, because inflation's come down, and we're doing all the right things. So I think we're more like in 1996 than in 1999. Still early on. And again, if this is the roaring 2020s, the decade still has a ways to go.
Really interesting. Let's talk about some of the things that other people seem to be getting wrong. Quote, you don't get a recession when unemployment is at all-time lows. Explain. Well,
the pessimists would respond to that by saying, if you look at a chart of the unemployment rate, it's always at a cyclical low or sometime an all-time low right before recessions, which is absolutely true. So when you see it like this low, you do have to start to worry about the historical precedents. I think a lot of the people who've gotten it wrong so far, they may still get a recession. I'm not saying it's impossible, but a lot of them look at charts and said, look, the yield curve's been inverted, and every time it's been inverted in the past, that's led to a recession. Leading indicators have been declining, and every time that's happened, that's been a recession. But I think that what many of them got wrong is that the process by which we get to recessions is the key here to understanding why we haven't had a recession. The inverted yield curve in the past really did a good job of predicting a process that led to recession. So what was that process? The Fed would be tightening, raising interest rates. And then at some point along the way, the bond investors would start to say, you know what? I know I could get a higher yield on a 2-year than a 10-year. But the 10-year is okay here because if the Fed keeps raising interest rates, I want them to keep raising interest rates because something will break, and then I'll be very happy owning a 10-year bond because those yields will come tumbling down. And so what the inverted yield curve does, it doesn't cause recessions. And I wrote a little study on this in 2019, so I've been thinking about this for a while. And what the point of that piece was that what happens when you get an inverted yield curve is the bond market starts to anticipate a financial crisis, and lo and behold, something does break, and then that becomes a credit crunch, and that's what causes a recession. So you need to see a crisis, a credit crunch, and a recession. That's been sort of the usual way it happens. And this time around, the inverted yield curve got it absolutely right again. We had a financial crisis in March of last year that lasted all of 2 days before the Fed came in and provided a tremendous amount of liquidity, and we never had a recession.
How often do we get an inverted yield curve starting with Fed funds rates at zero? This seems to be almost a case of first impression.
Yeah, well, again, the pessimists, the crowd of naysayers, had a very logical position, and that is, how could you see rates go from 0 to 5.25%, 5.5% without something breaking, without having a recession? And the answer is, yeah, they were right. Something broke, but the Fed had so much experience during the great financial crisis and again during the great virus crisis playing whack-a-mole in the credit markets. There'd be a liquidity crisis and they'd whack it and create another liquidity facility overnight. And that's what they did last year. Overnight, on a weekend, they came up with a liquidity facility that calmed everything down. So the crisis did not turn into a credit crunch and therefore did not turn into recession. High interest rates, I think we've been learning here, don't inherently cause a recession. Obviously, they caused a recession in the housing market, but I've been making the point for the past 2 years, well, be very careful because the housing market, it was single-family housing that went into recession.
Right.
Multifamily did quite well, and so I said, you know what, let's talk about it as rolling recessions. And I've been doing this for a while, so in the mid-'80s, I think I came up with the term rolling recessions back then when energy prices collapsed and everybody thought that the recession in Texas and Oklahoma was going to go national, and it didn't.
Huh, interesting. Let's stick with the Fed because there's some really interesting quotes of yours I want to throw your way. Quote, there's really no need for the Fed to lower interest rates. Could be the most controversial thing I've heard you say the past few months. Tell us why you think the Fed is fine at 5.25.
Well, I think the Fed officials have this notion that the real interest rates matter. That if the Fed funds rate at 5.25%, 5.5%, and the inflation rate is 5 or 6%, then you obviously don't, you have a very low real interest rates, inflation-adjusted interest rate.
Right.
I have a problem with that whole concept anyways. How do you inflation adjust an overnight rate and what behavior does that actually impact? But now they're saying, now that inflation's come down, let's say to 3%, right, that the real rate's gone up and, oh my God, it's going to be restrictive. It's going to push the economy into recession. I said, that's not my model for recessions. My model is inverted yield curves, financial crisis, credit crunch, recession, and I don't see that happening. So the economy is demonstrating that there's no call for freezing. But there is this view that comes from Milton Friedman that there's this long and variable lag between monetary policy and the economy, and I dispute that. I say, well, actually, there's no lag at all. That's just tell me when the crisis is going to hit. Then the next day will be the credit crunch, and the day after that will be the recession.
To be fair to Milton Friedman, back in the 70s, we had a lot less data. The Fed didn't even announce. Like people, the young folks today don't realize there wasn't even a Fed announcement that rates had been changed.
Yeah.
You had to track the bond market and money supply to have a sense of what was going on. So maybe there was a long and variable lag in the 70s or even the 80s. But today, the Fed tells us what they're going to do. Then they go out and do it.
Yeah.
There's no surprises. Another phrase of yours that relates directly to this, Wall Street seems to be expecting 4, 5, 6 cuts. You've been saying fewer and later, maybe 2 or 3 cuts, and that's it.
And maybe not. Yeah.
So I know a lot of people that are banking on rate cuts coming.
Yeah.
You're much less convinced.
I think it's people who would like to see the bull market continue and think that the only way that's going to happen is if the Fed provides the sweetener to make that happen. But I think the stock market's already demonstrated that they'll take the trade. In other words, if the deal is rates don't come down, but the economy remains fairly strong and earnings come in strong and we have another technology boom, then we can live with that.
Your latest report, your latest topical study in praise of profits, those people who have been claiming zero interest rate policy and quantitative easing are the only things that were supporting the stock market in the 2010s. And now that rates have gone up, you're going to see how important the Fed was to equity prices. That's not proving to be true yet.
Yeah, I think that's another problem with macroeconomic models and the financial press, quite frankly, and that is always this focus on the Fed and on Washington and the policymakers. And I keep pointing out that it's amazing how well this country has done for so many years despite Washington, despite the meddling of the government. And what we have to do is give ourselves credit. Us working stiffs, we go to work every day, and we try to do things that make things better for us, our families, our communities. And you know what? We succeed despite the meddling of Washington. And that's what kind of gives me hope that as crazy as things are in our political system, the economy just continues to deliver. And anybody who, didn't like a Democratic president that bet against the stock market, anybody who didn't like a Republican president that bet against the stock market missed some pretty awfully good returns.
I heard Obama was going to kill the stock market. Yep. Didn't happen. I heard, now Trump is in. He's going to kill the stock market. Didn't happen. This Biden's going to kill the stock market. Didn't happen. I mean, the takeaway is pay attention to profits and ignore what's going on in D.C.
Companies, businesses, whether they're public or private, we're all become very, very good at managing in challenging times. And sometimes those challenges come from the government. It shouldn't be that way. The government should be on our side, not kind of trying to pick in our pockets. And yet we do remarkably well.
So one of the things you said about inflation I found both to be fascinating and unique and very insightful. You were the first person I saw that pointed out CPI tends to go down as fast as it went up.
Yeah.
There's a symmetry here. When you get a giant surge, you'll get a giant collapse.
Correct.
Which is what we saw in 22 and 23.
Yeah.
You go back to the 70s, it's long, it's slow, it builds, it's structural. That sticks around for a long time. Again, I have to ask, what is it that makes this so symmetrical? Why is it that way?
Well, the 70s was, with the benefit of hindsight, certainly so far an outlier. You had two energy shocks. You started out the decade with Nixon devaluing the dollar by closing the gold window. So the dollar took a dive. Commodity prices soared. The anchovies didn't show up in Peru, so that affected soybean prices somehow or other. I wish,
butterfly effect.
Yeah, it was really crazy kind of stuff. And inflation was coming down after, the 73 energy crisis. But then we had one in 79 and it went back up. Also, labor unions were very powerful. 30%,
wage spiral, sure.
35% of the labor force had union contracts and they had cost of living adjustments. Now I think something like 10% of the labor force is the private sector labor force is unionized. So the COLAs aren't widespread. So you didn't have this kind of automatic wage price spiral, which is what we had in the 1970s. But in the current situation, look, we had a terrible pandemic. I mean, you have to be realistic. You have to, go with the flow of what's actually happening instead of just imposing a model. And what a lot of the models missed is, hey, we had a pandemic. It disrupted supply chains, and that lasted for a certain period of time, and they got fixed. And by the time they got fixed, consumers had already gone on a buying binge for goods and said, no mas. They didn't really need any more goods, and they swung over to services. And so goods inflation's come down. By the way, I think the other thing that the folks missed on why not getting inflation right is they didn't look at it globally. I mean, it was a layup that certainly it became obvious in fairly early on last year that China was in a property bubble depression. And again, I've been doing this for a while, and I saw it in Japan in the 80s. I saw it in the United States in 2007, 2008. And these property bubbles, it takes 5 to 7 years to get out of the deflationary consequences of them. And now people are starting to recognize that the Chinese are so desperate to goose up their economy that they're going wild on production. They're producing a lot of cheap cars and appliances, and they're exporting them around the world. And that's extremely deflationary.
Really intriguing. Let's talk about housing for a moment. Lots of folks are deeply concerned about commercial real estate. I know you've been a little more sanguine than some of the doomsayers in that space. What's going on with commercial real estate?
Well, I put the commercial real estate story in the context of rolling recessions. And by the way, now we're seeing some rolling recoveries. For example, demand for goods by consumers is now starting to show more activity. But the idea was that, okay, we are in a rolling recession of the commercial real estate market. But commercial real estate is a very diverse kind of market.
It's multifamily homes, it's warehouses, it's medical facilities. It's not just offices.
Yeah, the other thing I'd point out is that in the Great Depression, there was no distressed asset funds. And again, this came from my understanding of the S&L crisis, is the S&L crisis was finally resolved with the Resolution Trust Corporation, the RTC, and Wall Street said, hey, this is a great idea. Why don't we do this? Why don't we put together a lot of money and just wait for something to blow up and buy stuff at 25 cents on the dollar, and then we have plenty of cash to fix these things and restructure them. I heard about a mall going out of business in Arizona that's now a pickleball facility, and so it's we have a remarkably good industry that knows how to deal with distressed assets and clear the market, so that instead of having a calamity in the banking sector, somebody loses a lot of money in their portfolio. It reduces your rate of return in some portfolios, but somebody gets a really good deal out of it and turns it around and is hiring people again. Right.
There's no such thing as toxic assets, only toxic prices.
Correct.
So let's talk about residential real estate. What's happening in that space? Clearly a huge shortfall in supply. How long does it take for that to get fixed?
Yeah, that's a very complex situation. And I think it reflects a whole bunch of different developments. Certainly, one of them is that a lot of people refinance their mortgages at record low mortgage rates, and they're kind of hesitant to sell their house. They don't want to sell their house and buy another house if they still need a mortgage at these kind of mortgage rates.
Right. So they were 3.5%. It's 7% now. Yeah. So that's a bad trade.
Not only that, but it's like it makes you feel smart living in a house where you're not paying much in a mortgage. And by the way, 40% of people who own houses, 40% of them don't even have a mortgage. That goes back to the story about the older Americans, the baby boomers, don't really have much in the way of expenses, but maybe they're not moving either. I mean, a lot of people may be moving down south, but some people are saying, it wasn't a bad winter here in New York. Maybe we'll stay. Maybe we'll get us a small place in Florida. So there's a lot going on here. But look, the home builders, who would have thought with mortgage rates at these levels that the home builders would be, such great performers in the stock market? But it's this great opportunity for home builders. Yeah. I think a lot of this has to do with regulation. It's hard to get land. It's hard to get permission to do what you want in building housing. So I think a lot of that is really more, once again, the government meddling.
But that's local government, not national government. You underbuild single-family homes for a decade as the population grows.
Right.
But I'm more surprised we didn't anticipate this coming sooner rather than later. Everybody felt post-financial crisis, oh, that's it. We're never going to see a demand for housing again.
And it's having a tremendous impact on younger people. Some of them are still living at home, and they're delaying, obviously, having families. And even if they have an apartment, they may be delaying having families. So this is having demographic consequences that will have an impact along the way.
We saw reduced household formation during the 2010s, but that seems to be picking up again, right? I know that's something you track. When household formation rises, demand for houses tend to follow, right?
Absolutely. And so, again, we've had this rolling recession that's hit housing, single-family housing, and yet home prices are all-time record high. So you really have to be very flexible in looking at this economy and recognize how things change and, how models that used to work don't work anymore.
Let's talk about fiscal stimulus. You wrote a really interesting piece a couple of weeks ago. We had the CARES Act. CARES Act 1 was 10% of GDP. CARES Act 2, CARES Act 3. CARES Act 3 under the Biden administration, the 2 previous CARES Act under the Trump administration. The CHIPS Act under the current administration, the Infrastructure Bill, the Inflation Reduction Act. Many of these are not single-year spends,
Correct.
but decade-long programs. Given the work you've done with Tobin on fiscal stimulus, how big a wind is at the back of this economy given the coming decade of fiscal spending?
I think, again, the answer is in the data, and what the data shows is that, there's this monthly report called Construction Put in Place that comes out from the government, and it's every month the numbers are phenomenally strong outside of residential construction. So what we're seeing is that infrastructure spending, all-time record high. All these programs really are translating into actual dollars being spent on rebuilding or building new infrastructure. When you look at the private sector construction of structures, you see that manufacturing facilities are soaring. So we're building lots of those, EV plants and battery plants and semiconductor plants and so on.
You've been talking about onshoring, so the reverse of what we saw in the 80s and 90s of offshoring.
Yep.
How significant an economic factor is, and obviously a lot of this traces back to the pandemic when we couldn't get, medical protective equipment or masks, or really it was shocking to realize how much crucial infrastructure we decided to outsource. How substantial a chunk of the economy can all this onshoring be, and how long-lasting is this?
Well, that's a great question. I'm thinking that, as you said, it's got legs. It's going to be with us for a while. And then, of course, once these facilities are built, there are going to be a lot of automation and robotics there, but they're still going to need to be supported. I mean, even artificial intelligence, given what we know about it today, requires a tutor to say, no, you're
stop hallucinating.
Yeah, stop hallucinating.
Right.
So humans are still going to be essential. And we've got a very tight labor market particularly for skilled workers. And as a result of that, I think that the onshoring effect continues. I mean, we've got really cheap energy here. Natural gas prices are low.
Record oil production.
Yeah,
all-time highs.
I mean, you reduce your transportation costs if you produce here rather than elsewhere. But the labor problem is a problem, but I think it gets solved with innovation, with technology and providing robotics, automation.
What about the high-skilled immigration? That used to be a big part of the labor market in the 90s.
I'm struggling with that immigration issue. I mean, we're talking not tens of thousands or hundreds of thousands. We're talking a few million. This is
shortfall of bodies to fill jobs.
Yeah, but you got the migrants coming in, and the question is, at what point will they be allowed to work? At what point will they be actually reflected in the official statistics? And how many of them will actually be left here depending on the politics? I mean, there's one presidential candidate that has basically said that he's going to send them all back. So it's,
how realistic is that? We've heard that before. It doesn't really happen, does it?
Well, the reality is that what we need is a lot more legal migration.
Legal. So when I talk about immigration, I'm really talking about Silicon Valley and C-suite executives and high-skilled people coming from places like China and India and Vietnam and Turkey and other places where Eastern Europe, where they're highly educated in the STEM area, which we certainly could use more of.
We could use more of, absolutely. And and for many of them, they want to be here. They'd love to be invited here, and it's safer here. If you're in Taiwan, well, why not bring more people over from there, from Eastern Europe, with skills? But legal migration is the way to go, because then you know that the people that are coming in are going to be working as opposed to being a burden on the social system. But that gets so political these days. It's
hard to talk about.
It's hard to talk about.
You mentioned legs. Let's talk about legs. Quote, "This is a long-term bull market." Discuss where we are in this bull market and how long could the long term be?
Well, look, I think what clearly everybody knows, and certainly has had a big impact on the psychology and the thought process that went to thinking about the past couple of years, is that recessions cause bear markets. Mm-hmm. The bear market anticipates that the way things are going in the credit system, we're going to get a bear market to stocks. And what happens is earnings expectations go down, and then valuations go down, and earnings get really whacked because not only do revenues go down, but the profit margin goes down. So everything goes wrong, and the only question is, are you going to be down 25% or 50%, and is it going to last a year or is it going to last several years? And so there's a lot of uncertainty around that, and people say, get me out, I don't want to take risk. So I think to have an opinion about how long this bull market's going to last, you have to have an opinion of, well, if we didn't get a recession, we had the most anticipated recession of all times the past 2 years, the Godot recession, the no-show recession. Maybe it'll show up, but if you agree with me that historically you need to see that tight monetary policy causes financial crisis, credit crunch, recession, and that's not very likely, especially now that the Fed has I don't think they're going to be raising rates again. And if we get into trouble, I think they will lower interest rates. So it's, how do you get a recession when the Fed now is on the right side of the monetary policy cycle, and they have room to lower rates if that's necessary? But I raise the question of whether that'll even be necessary, because I think the economy remains resilient. I think interest rates are appropriate where they are right now. And so I don't see a recession. And I've been promoting the idea of the roaring 2020s scenario.
Well, it's 24, so you're saying 4, 5, 6 more years to go?
Yeah.
So it's interesting because...
And those could be the biggest of the roar.
Always the end of the bull market is the greatest gains.
Yeah.
So when we look back at the past 2 years, we're recording this towards the end of the first quarter in 2024. 2022, S&P was off not quite 20%, about 19%. The NASDAQ down about 30%. No real recession. On an inflation-adjusted basis, you had a couple of negative quarters of GDP, but you never had the full, broad requirements of an actual recession. And then the great recovery in 2023, where does that leave us standing here? You mentioned not too long ago that, hey, this market's come a long way. Maybe it's time for a breather. Yeah.
About a year ago, really now, I predicted that we would get to 5,400 by the end of this year.
Not that far away.
That's the problem I'm having here is like, I don't want to see this by the middle of the year.
I was going to say, you go away in August and take the rest of the year off.
Well, same thing happened last year, by the way.
Right.
I thought we'd get to 4,600. We got to 4,800. But we got to 4,600 by the middle of last year instead of the end of last year. And so, I said, well, I'm not going to raise my forecast here. And then I did actually anticipate the correction that we had, 10%. And then that was down. The low was made October 27th. And it's been vertical since then as the AI.
And just to put this in context, you take the sell-off in 2022, you take the recovery in 2023, and the average over those 2 years, you're flat for 2 years.
Yeah.
That's why every time people say, oh, we've come so far so fast,
yeah.
Flat over 2 years doesn't seem that far.
That's not much of a return.
That's exactly right. So you're talking about AI. Mm-hmm. Again, many people seem to like to talk about that as a bubble. What do you see going on in that sector?
Well, I think at this point, given what I've experienced personally with things like ChatGPT, I think the roaring 2020s have started to get discounted in the stock market on November 30th, 2022. That's when OpenAI introduced ChatGPT, and so I immediately signed up for the $20 a month version of it.
Pretty reasonable, right?
It was reasonable, $20 a month.
Through your Microsoft account.
Yeah, and I thought, man, this is really great. Maybe it'll write my research for me, and I can just do it from the beach. And I found out that I was spending more time finding the mistakes that
It's only going to get better.
It's only going to get better. I mean, right now, it's kind of like autofill, where you're typing on Word and it starts to anticipate what the next word might be. So it's kind of like autofill on speed and steroids. I mean, it actually gets you back to the old idea that Benjamin Franklin gave us, which was speed, haste makes waste. Mm-hmm. And so it's too fast. It sounds kind of credible. And I saw somebody did some really beautiful videos, and one was a bull in a china shop, and the bull kept hitting all the china, and none of it broke. So, the editor has to go back and explain to the artificial intelligence that when the bull hits that, you got to show it as being broken. So it requires a tremendous amount of hand-holding, babysitting, editing, from what I've seen so far. But so much money is being thrown in this area, and it's basically just hypercomputing. It's the ability to anticipate what's going to come next. But some human is going to continue to need to monitor these things.
I have personally found that I spend less time with Google when I'm researching a topic and more time with either ChatGPT or Perplexity, which is either Claude or I'm forgetting the other engine that drives that. Because it organizes the answers in such a usable way.
Yes, it does.
And Google has just become a mess of ads. And they were getting away with this for a long time, and suddenly people accuse them of being a monopoly. Mm-hmm. Clearly they're not if a simple app can eat their lunch the way they are.
Well, that's the wonderful thing about technology is capitalists who use technology are always looking for opportunities to put somebody out of business that's got a great business model. I understand that the CEO of NVIDIA runs the company with the assumption that it's going to go out of business unless he's constantly thinking about what the next new thing is. And, he started out with gaming and then went to Bitcoin mining, and those worked until they didn't work. And now he's got GPU, and he realizes that there's going to be something after GPU.
Since you mentioned Bitcoin, I saw a quote of yours asking the question, is Bitcoin digital tulips? Tell us about Bitcoin.
I don't want to get any hate emails from people who love...
Have fun being poor, Dr. Ed.
Well, that's the thing is I want to confess that I've got a tremendous amount of FOMO, when it comes to Bitcoin. I kept looking at it when it was 2 digits in price and 3 digits, and it just kept going up and up. And I said, this has got to be a bubble. It may still be a bubble in the sense that there is a comparison with the tulip bubble in Holland centuries ago, but there's a huge difference, and that is once the tulips were sold to all the suckers in Amsterdam, that was the end. That was the beginning of the end of the bubble burst real quick. What's unique about Bitcoin is it's a market that's open 24/7 on a global basis. And there's a lot of people like myself with FOMO. I'll probably get in at the top.
Let me know when you buy so I can sell mine. I have a little bit of Bitcoin and a little bit of ETH that we bought a couple of years ago. I mean, maybe I'm break even. I don't even pay attention to it. I think of it as like a single company. Yeah. Like, hey, it's an Amazon or an Apple, and if it works out, great.
Yeah,
and if
I'm not going to tell anybody that they're wrong to have it. I mean, I just, you need that on a global basis. You continue to have buyers, and so far so good.
It would have been nice to buy it when it was $100. Yeah. That would have been
Look,
fun.
I'm an old-fashioned kind of of economist and strategist. I need earnings, I need dividends, I need rents, I need something I can value. I don't really have any of that.
You're not a commodity investor, really.
Not really, no. I mean, commodities go up, they go down, and it's the old story. The best cure for high commodity prices is high commodity prices.
Classic.
But again, that makes Bitcoin different because the algorithm is such that higher prices don't lead to more supply, though it does lead to more competitive Doge coins and things like that.
Really interesting. Let's talk about the book that you put out not too long ago, Predicting the Markets. You cover 4 decades as an economist and a strategist on Wall Street, and you put out so much research every day. How on earth did you find the time to put this together?
Well, I don't play golf.
Okay.
So that saves a lot of time. I do play tennis.
Yeah.
And that's only about an hour. But I really enjoy it. And when it comes to the book, I've been doing this for a while, more than 4 decades. And by 2015-16, I got inspired to put together what I'd learned and mistakes made and insights accumulated. I felt like, anybody who's just kind of getting into the business, they're not going to be able to experience what I experienced. It's exactly what the title says. It's a professional autobiography. I actually did have quite a good time writing it.
And you talk about predicting everything from stocks, bonds, commodities, currencies, earnings. How challenging is it predicting the future when, the world is so uncertain and there are so many random events?
Well, that's what makes it so interesting, right? Is, there's no clear way to get it right all the time.
But you've gotten it a lot more right than most people. And we'll go through a quick list of things. I have to ask you what you saw in each of these that led you to the right prediction. Starting with, in the early 80s, you identified disinflation coming from globalization and technology and the bullish result of that into the equity markets. What were you looking at that led to that conclusion?
Well, in the early 80s, my focus was on disinflation attributable to the Fed tightening up on monetary policy, and that we would have a pretty severe recession and that would potentially be deflationary.
And we ended up with a double in, what was it, 81 and 80 and 81 or 80 and 82?
Yeah. But then along the way, globalization became a big deal in terms of my analysis, especially with the end of the Cold War in the late 1980s. I'd observed, based on the U.S. CPI going all the way back to the 1800s, the CPI has these peaks historically. They're not random. They're actually associated with wars. And so my thought was that wars are obviously inflationary. World trade gets cut off. Competition is cut off. Commodity prices go up during war times. And so I said, well, wait a second. So if this is the end of a great war, the Cold War was, there was some heat to it between Vietnam and Korea and all that. But it was maybe even a continuation of World War II in some ways.
Big spike in the mid-40s, early 50s in inflation?
Yeah. That was actually one of the models that I looked at for thinking about the current situation is that we had this huge spike in the after the war in durable goods inflation because all the soldiers came back and they wanted cars, and Ford was building bombers. And so it took them a couple of years to retool, and then all those durable goods inflation came down like a stone, just the way it did in the current environment when we saw durable goods inflation going up with the supply disruptions, and then once the disruptions were ameliorated, it came right back down.
I think that's the best parallel to the post-pandemic.
Yes, I agree.
People talk about the 70s and the 90s. Really, you think about moving from a wartime footing to peacetime footing, and that whole transition and pent-up consumer demand.
So when the Cold War came to an end in the late 80s, the Berlin Wall comes down, most economists are saying this is going to be terrible for inflation because all these people behind the Iron Curtain are going to want everything. It's going to be terrible for interest rates because they're going to need to borrow money. It could work the other way around. It could be that all these people create bigger markets, more competition, more globalization, as we call it now. Détente was a very powerful disinflationary force.
Really interesting. In 93, we talked about this earlier, but I want to spend a little more time on this. You called technology's growing impact the high-tech revolution. That's a big, weighty phrase. What made you realize, hey, this is more than just an incremental shift in how we spend money. This is revolutionary. Right. What were you looking at?
I have to admit I'm a bit of a geek. I grew up in California, in Campbell, California, which is right next to San Jose, and my father worked for IBM. And this was back in the 60s, and he used to bring home Fortran COBOL manuals and things like that. I had a lot of technology around me in California. I wish they wouldn't have moved back to the Northeast because I'd probably be a billionaire by now because I would have gotten into all that.
And the better weather,
and the better weather. Yes, I've always had this fascination with technology, and it's been my view that economics has been badly merchandised as the optimal allocation of scarce resources. That's just a depressing idea that, there's only so much and we all have to figure out the best way to distribute it. Well, no. Economics is actually about technology solving that problem.
It's about abundance, not scarcity.
Yeah. And so I started to, I was an early believer in the internet. And so early that in 1995, as I mentioned before, I had my own website, and I had publications on there. The charts didn't automatically update. I wrote some of it, but then I had a software programmer who knew what he was doing, kind of really polish it off. Again, at Deutsche Bank, which CJ Lawrence Deutsche Bank, we had Frank Quattrone's team coming in the 90s. So there was a lot of technology analysts, and so our morning meetings were full of discussions about technology and what impact it was doing. I mean, even when I was at E.F. Hutton, which was in the 80s, there was a lot of excitement about a company called Mitel, which was a telecom a company. And as a matter of fact, even back then there was a lot of hoopla about all this stuff.
Where did Quattrone end up? Was it Credit Suisse First Boston? I remember he was in a big shop.
I really don't know. I think eventually he went off on his own, but he did extremely well.
When was it clear to you that the technology revolution had morphed into a bubble in the late 90s?
When Alan Greenspan started to talking about justifying what had happened in the stock market as a lottery.
What year was that?
It was 1999. He gave a testimony about the stock market, and he said, well, things look stretched, but, you have to look at the stock market as a lottery. People buy a lottery ticket. It's not necessarily a rational thing, but, the payout is so great that it attracts a lot of buyers. So he gave what I call the lottery testimony, and that was one aspect of it. The thing that really nailed it for me, that really was some amazing timing, was Barron's ran a piece. I think it was actually at the beginning of 2000, maybe in late 1999, where they said that all these dot-coms were burning cash and they weren't going to get another round.
Amazon.bomb, I think, was the headline of. I don't remember if that was Howard Marks or Barron's or both.
Yeah.
But that was January 2000. Yeah. The timing was pretty good.
Yeah, I think also Jeff Bezos made the front cover of
Time magazine.
Yep. And that was the curse.
December 99. It was a quarter later. It was done. Let's talk about the 2000s. You identified the coming commodity boom after China joined the World Trade Organization in 2001. In hindsight, that's perfectly obvious. A lot of people missed it. Yeah. What led you to that conclusion?
I'd seen lots of photographs and a few videos of what China looked like in the 1980s. Not China overall, but some of the urban areas, Shanghai and things like that. They're all riding bicycles.
Right.
They're all riding bicycles in the 1980s. And then I'm looking at some of these pictures of what's going on after they joined the World Trade Organization in 2011 and 2001. They're all riding cars. And I'm reading about how you're getting all this migration away from the villages to the towns. And
from the farms to the city.
Yeah, from the farms to the city. And so urbanization always has a tremendous impact on an economy. We started to see all these ghost cities being built because the Chinese viewed empty apartments as a good place to stash some of their wealth. The commodity demand was pretty obvious, and you could see it in the charts, and I was recommending overweighting materials, energy, and industrials, MEI. This is after I and everybody else recommended TMT, technology, media, and telecom. That was what we all did in the 1990s. And then in the 2000s, it was MEI.
So let's talk about the period leading up to the great financial crisis. It was a lonely time to be a bear. Everybody was pretty bullish. What led you to turn bearish on financial stocks before the GFC?
Yeah, I don't want to take any credit for getting that market right other than getting the financials, which actually, when I think about it, was a pretty good call. I think in 2007, we started to get lots of news suggesting that the subprime mortgage market was going to could take the system down. And so I recommended underweighting financials. The better call would have been just get out of financials.
I recall being on TV in early 2007 talking about derivatives and subprime, and the anchors laughed at me. In hindsight, we all know what happened.
Yeah.
But throughout '07,
Yeah.
there wasn't a lot of love for anyone who was bearish.
No.
What sort of pushback did you get at the firm when you were talking about? By then, you had already launched your own firm.
2007, yeah.
So what sort of pushback did you get from clients saying underweight financials here? What was the response like?
Well, I've been around for a while, as I've said a few times on the program here, and I've got very good relationships with these people, and many of them have been listening to me and talking to me for years, so they kind of respect my opinion. I didn't really get much pushback. I mean, I explained why, and they said that makes sense.
What about the bottom call, March 2009?
I'm very proud of that one. I was at Merrill Lynch. One of my accounts was Merrill Lynch Asset Management in Princeton. I walked into the meeting. We were all depressed. This was actually March 6th, 2000.
Day or two before.
Yeah, so March 6th. The official low, I think, was March 9th.
Right.
But so I come out of the meeting, and one of the traders kind of walked by and said, how's the market? Said, it just hit 666 on the S&P 500. I said, that's the double number.
But by that number.
Yeah. So actually, I used that in marketing my thought. I said, this is like the Da Vinci Code. That 666 was it. But no, I thought that the bull bear ratio, which I tend to follow quite a bit, was down to 0.6. Everybody was bearish.
Everything was at an extreme in March 2009. I mean, whether you look at sentiment or what have you.
Yeah, there was the issue of mark to market, and I had started a conversation with Gary Ackerman, who was a congressman from Queens. I actually went to his office,
I recall.
And I said, "You got to stop this mark to market stuff. It's like a doom loop." And he listened. He didn't say anything. But then it was in March, I think March, right around after we bottomed, that he gave a speech in Congress in which he said they were going to hold hearings and try to determine why the regulatory agency hadn't eliminated mark-to-market.
There was a FASB rule change not long after then.
That's right.
The Financial Accounting Standards Board.
Yeah.
In the beginning, there was some mark-to-make-believe, we used to call it. But at a certain point, if you're holding treasuries, they're in your hold-to-maturity account. Why do you have to mark it every day? It's not relevant.
That was the point I made, and Ackerman bought into it, and he was on the committee that made a difference. So it all kind of came. So I kind of knew what was going on in Washington, which is occasionally has given me some insights, and not often.
So you've been pretty steadfastly bullish throughout the 2010s and 2020s. Yeah. What has kept you on the right side of this bull market trend this whole time?
As a matter of fact, during that period, I kept a logbook or a diary of what I call panic attacks. And so, when Brexit occurred, people got all...
2013? Something like that?
Yeah, something like that. Anyways, when Brexit occurred, there was expectations that the market would take a dive, and it did for 2 days. Right. And I said, okay, there's another panic attack. Because, the great financial crisis was so traumatic that ever since then, people have been looking over their shoulder for the next calamity.
Isn't it always that way?
It's always that way.
Don't these dislocations create a sense of PTSD amongst investors and traders?
Yeah, I think that's true. That's absolutely true.
I have to ask you about, you've been tracking the importance of the baby boomers to major trends. Is it true demography is destiny? Is that accurate?
Yeah. I mean, most economists don't really study or do much work on demographics because it's just too slow, to have any immediate impact. And all the cool kids are looking at, the business cycle and calling the next recession. But I think demography is extremely important. It's been very helpful to me in understanding the U.S., but I got an interest in the subject because I'm a baby boomer and there's 75 million of us, or at least that's how many were born. I had this notion early on in my life that I was special and really important. Then I started to work for a living, and started to study the economy, and I realized that I was just one of 75 million stiffs doing the exact same thing. Nothing special about me at all. But it did give me some, like, as Peter Lynch said, sometimes just look at your life and look around you, and that'll give you some real insights. So demography is important, extremely important, obviously, with regards to China. It helped me understand that. I mean, for the past few years, I've been saying China's not investable, partly because of the demographic issue. The consumers aren't going to be as red hot as people were anticipating, but it's also the government run by a Maoist.
Huh. Really interesting. Last question before we get to our favorite questions. I know you track sentiment and pay attention to what goes on with that. Over the past couple of years, especially following the surge in inflation, the sentiment has been worse than the 87 crash, worse than the dot-com implosion, worse than the COVID lockdown, and worse than the great financial crisis. How does this make any sense?
It's a great setup for the roaring 2020s, right? I mean,
climbing the wall of worry? Is that what it's going to be?
Climb a wall of worry. I mean, there's so many things to worry about.
But there's always things to worry about.
There's always things to worry about. I don't know. I mean, that's pretty scary stuff right now on a geopolitical basis. We didn't talk about that, but
Ukraine, Middle East,
Middle East,
Taiwan,
Russia. I mean, all that. It's all concerning. Stock market doesn't seem to care, and I think that's because the oil market hasn't really had an issue with it so far. So that's something to watch out for.
All right, so let's jump to our favorite questions that we ask all our guests. And you're the perfect person to ask the first question. Tell us what you've been streaming these days, what's been keeping you entertained. It could be either shows or films.
I'm a big fan of Netflix and the other movie channels. My wife and I do enjoy. We don't go to theaters the way we did, and so we do usually watch a movie at home on a Friday night. There's been a lot of really good flicks. One that I particularly thought was amazing was American Fiction.
Just came out.
It just came out.
Really looks great. It won an Academy Award.
Yeah, it won Academy Awards. I'm not sure for what, but
screenplay.
If I was doing, I think so. But I would have nominated. I would have. I think it was nominated for Best Picture.
And it's a great cast, also, isn't it?
It's a great cast, and it's got a lot of irony of it about identity politics, and it's political without being political. It's very human.
Yeah,
so
that's in my queue. Give us another one.
I saw Oppenheimer, but meanwhile, Spielberg keeps coming up with these great docudramas about World War II. And
Up in the Air, I think?
Yeah, Masters of the Air.
On Apple. That looks really fascinating.
Really, really good.
I saw a clip of one of the aerial dogfights. It's unbelievable.
It's unbelievable.
Right? You're like right there.
Yeah. Not only that, but when you realize that they got in these bombers recognizing that their chance of coming back was at best 50%, at best. Right. So, they were really just...
Cannon fodder.
The bravery, the achievement was absolutely extraordinary. I do like World War II kind of docudramas.
I know you saw Oppenheimer. I assume you saw Barbie.
Yep.
Any other films you want to mention?
I think it's Griselda. It's a docudrama about a lady who was a huge cocaine dealer
right.
in Miami. And she was very entrepreneurial. She figured out that there was a huge market in selling cocaine to upper middle class people. And
the wife from Modern Family. I'm drawing a blank on her name right now. She's hilarious.
Oh, she was phenomenal. The acting was absolutely great.
Huh. Let's talk about some of your early mentors who helped to shape your career.
Well, I recall being at Cornell University, and I was a member of a group that kind of brought in interesting speakers on economics and politics. And so I pitched Henry Kaufman over at Salomon Brothers, and I gave him a call, asked him if he'd have any interest in coming and giving a talk to us. But he sort of was my role model. He certainly wasn't my mentor. I liked the idea of being on Wall Street and being an economist, so I'd say he was kind of relevant in that regard.
Let's talk about some books. What are you reading now, and what are some of your favorites?
Well, I think it's called The Engineers that won World War II, and so I'm reading that. I had read another book about Liberator Bomber So that's why I really enjoyed the Spielberg show. Other than that, these days I haven't had a lot of time to read because we've been upgrading our chart system, and I introduced this new product, the Quick Takes. So that's kept me pretty busy. So I'm writing a lot more than I'm reading.
So let's get to our final two questions. What sort of advice would you give to a recent college grad interested in a career either as an economist or an investment strategist or both?
I think first and foremost is learn to write. Unfortunately, from my minimal observations about younger folks these days, they don't really know how to write. Maybe that's because everybody's texting and sending messages that way. Knowing something about grammar and being able to communicate in writing is important, but so is being able to do so verbally. We live in a very media-oriented kind of world these days, so I think that's important. History has always been important in my way of thinking about the markets. There's a long history to the stock market, and now that history has become more relevant than ever. People are talking, is it the 1920s, is it the 1970s, is it the 1990s? And so it helps if you have a certain grounding on how that all works. I would even say geopolitics, understanding, what are the risks in the Middle East? Who are the players? What are the history of that area? Having a good solid background in all of that, I think, is helpful. Most importantly, don't get hung up with learning from somebody who's selling a model that explains everything.
Huh. Really interesting. And our final question, what do you know about the world of investing and research analysis today you wish you knew 30 or 40 years ago when you were first getting started?
This may sound remarkably trivial, but I wish I knew, but I didn't really fully appreciate the power of dividend investing. The people that I see that have the biggest smiles on their faces in my cohort of baby boomers are the ones who've been long-term investors. They bought stocks, they bought property, they invested for the long haul, and they didn't get pushed out of the market, by volatility. They found opportunities. The benefit of hindsight, I would have invested personally, and I would have had stocks today that I would have bought many, many years ago, which I don't.
Just the power of compounding.
Just the power of compounding. Even a company like, and it's not even dividends. I mean, if you think about Microsoft, there was a point where Microsoft, in the 90s, was the hot place to be, and then for many, many years it wasn't the hot place to be, and look at it now.
Just past Apple for biggest market cap again.
So if you just have a diversified portfolio of well-managed companies, I think the idea of buying companies where the founders are still there seems to be also a useful insight into what companies you want to invest in. People who kind of view their companies as their babies, that they created them. They want to make them better. It doesn't always work. Uber's management had to change along the way.
WeWork as well, but I could give you 100 other examples where it has worked. Thank you, Ed, for being so generous with your time. We have been speaking with Dr. Ed Yardeni. He is the president and founder of Yardeni Research. You can find all of his research and writings at yardeni.com. If you enjoy this conversation, well, check out any of the previous 500 or so we've done over the past 9 years. You can find those at iTunes, Spotify, YouTube, wherever you find your favorite podcasts. Be sure and check out my new podcast, At the Money, 10-minute conversations with your favorite Masters in Business guests discussing the most important subject for your money. Earning it, spending it, and perhaps most important of all, investing it at the money on Bloomberg Radio and in your Masters in Business podcast feed. I would be remiss if I did not thank the crack team that helps put these conversations together every week. Juan Torres is my audio engineer. Atika Valbron is my project manager. Anna Luke is my producer. Sean Russo is my head of research. Sage Bauman is the head of podcasts here at Bloomberg. I'm Barry Ritholtz. You've been listening to Masters in Business on Bloomberg Radio.